Does Marqeta deserve a spot in your portfolio? Let's run through the bull and the bear case in about 5 minutes. My name is Brian Feroldi.
My name is Brian Stoffel. Now, Brian, Marqeta is a recently public company that not many people have probably heard about in real life. What does Marqeta do?
It took us a little while to figure that out, but Marqeta is a fintech company that operates a cloud-based software solution that provides cards issuance and transaction processing services to other companies. Its major customers include Square, DoorDash, and even JP Morgan.
But what does that all mean in real life? Well, you can break down the business into three buckets. First, it can issue cards. So companies can issue real or virtual cards to their customers or employees. But importantly, it can also process the funds going through those cards, especially with something called JIT funding, which is just-in-time funding. And finally, Marqeta offers a full suite of applications that you can choose to use to help you optimize the cards that you are sending out to your customers or employees.
One thing that blew us away when we were researching this company is its growth rates. Not only is its revenue growing more than 100% per year, but its dollar-based net revenue retention rate is over 200% recently. That's a number so high, I've almost never seen that before. So what's the bull case for investors? Well, first off, that high dollar-based net revenue retention rate suggests that the company's switching costs are very high. That means that once a company adopts Marqeta's solutions, they're going to have a very hard time switching away.
Second, recent history has already shown that there is insane growth with Marqeta right now, but they've still captured about 1% of their total opportunity, which means that insane growth could continue for the foreseeable future.
Third, one thing that pleasantly surprised us was how little this company spends on sales and marketing in order to attract new customers. That makes sense given that it's going after enterprise-grade customers, but that low sales and marketing was a big positive.
As impressive as those growth numbers are, it's important to examine the bear case. Now, with Marqeta, the most important thing to be aware of is concentration risk. One customer, Square, accounts for 2/3 of the company's revenue. And while we believe the relationship is solid, should Square decide to try and do this on their own or leave for a different provider, it would be a huge blow to Marqeta and its shareholders.
A second thing to keep an eye on is the company's bottom line. It is not yet producing profits or free cash flow, although it's closer to producing free cash flow than it is profits.
Finally, when we investigated the company's stock-based compensation, we saw that shareholders were getting diluted at a fairly high level given the size of the business that we're talking about, and we'd like to see those numbers regulate at a lower base.
How did Marqeta score on our investing checklists? For me, this company got a 64, which is in my why bother category. A few major areas of concern for me are the customer concentration issue and the lack of profitability.
And Brian, for much the same reason as you, this landed in my fragile category with a score of a 5.5. By far, the biggest reason that it lost points was because of that reliance on its relationship with Square.
So what should investors keep an eye on moving forward? The number one thing that both of us agree on was customer concentration. An overwhelming majority of this company's revenue currently comes from Square. We want to see Marqeta not only sign up new customers, but get those other customers to spend so much more that that number comes down significantly over time.
Second, there's a metric that investors should look for every time the company reports earnings called total payment volume, or TPV. That counts the amount of money changing hands through Marqeta's cards. The higher that goes, the better their customers are doing and the larger the moat is around the company.
Third, keep an eye on profitability. While it's likely to be several more years before Marqeta starts driving net income, the company is close on a free cash flow basis. Once that number turns positive, this company's risk level will go down substantially. Overall, we think Marqeta is a fascinating fintech company to watch, and we are very impressed with the company's high growth. But there's still work for this company to do before we enter either of our portfolios. Brian's out.